Good morning, folks. Welcome back. The week is over, and it's been a bit of a roller coaster ride, right? I'm just going to tag like word cloud style the type of things that have driven markets predominantly. So when we opened the week, we were really focused on NVIDIA, right? NVIDIA earnings. Where does NVIDIA fit into the context of the market? And it has been a name that has 2x'd throughout the course of the year. It's about a 200% gain. The earnings around it have been super volatile. But then we've also determined from kind of analyzing the broader market that most of the return generated by the indices in the States, by the S&P in particular, have been tied to NVIDIA. So no NVIDIA, no market for some respect. And that kind of leads me to why I'm late this morning. Was last night I was talking to a hedge fund trader, a friend of mine, and he was kind of pounding the table on the fact that he thinks credit is going to outperform equities. It has in his terms. Now we have to like unpack a little bit how he's viewing that, sort of what's happened with inflation, what's happened with risk, what's happened with rates on the bonds as well. But the reality that he's pointing out to me, which is really interesting, I'm sorry I don't have a chart, but I will share it in the Discord once I get it from him, because he's going to do a little highlight for me, is that what you are getting paid to own risk equities, it just makes no sense versus what you're getting paid to own extremely low risk credit. And by that I mean bonds. So to simplify what that means, basically the market is such today that you can buy something that represents virtually no risk. By virtually, I mean 99% no risk. At least that's how even the most sophisticated investors in the world view this, with U.S. Treasury bonds or with extremely high quality corporate credit. That becomes a little bit stickier. But let's just focus on U.S. Treasury bonds and bills and notes. These are risk-free. I don't believe in that term, but let's call it 99% risk-free. They pay you 5%. Many financial institutions, if you have that in your portfolio, they basically consider it cash, especially for lending and whatnot. So for no risk, you get 5%. For extreme risk, you get things like 200% or 30%. We look at the indices this year, right? So the S&P this year, it's marking up like a 14% gain. The NASDAQ, I think, is starting to touch sub 30%, like 29, 28% for the year, coming down from its lofty, plus 30% for the year. However, you had to take enormous risk, and things could have gone just as easily the other way, right? We spent the entire year thinking a recession was going to hit, very worried about inflation not getting put under control. So on a relative basis, you're really only getting 10% more. If we're talking about the S&P, the S&P makes it pretty crystal clear. You're getting basically less than 12%, less than 10% more for taking enormous risk, right? Because stocks could have been down 30% this year, happened last year, versus 5% with nothing to worry about. So the risk premium that you're getting paid on equities doesn't really make sense. And this is a first in my career and a first in this trader's career as well, because during the tenure of our careers in this industry, there have been basically zero rates the whole time. We started to laugh when rates were touching 2%, 1+, several years ago pre-COVID, because it was like, is this really going to happen? Is this going to work? Are they ever going to be able to push rates back up without inflation present in the economy? And the answer was no, but now it is. I mean, and it's almost hard for people to believe because there's so much action in the stock market. But to wrap that thought up, this week looks like markets might actually finish on a positive note, coming back from last week. And today we have the infamous Jackson Hole meeting, where you have many central bankers of the world quietly shuffle into Wyoming and give, what their outlook is looking forward on a macroeconomic basis, on a domestic basis here in the States. And it tends to give investors clues as to what's going to happen with interest rates and what they expect with the market. That said, people behave a little bit differently depending on their outlooks. And the smartest investors, the smartest corporate executives, they stick to a conviction and they execute. And so it's been really interesting, right? While the whole this whole week, people have been very fixated on AI, Nvidia, where can this thing go to? What is the inherent value of AI being implemented into a tech business, into a financial business, etc. And you see all these equity research analysts publishing corrected price targets for Nvidia. If they previously thought it would go to 450, now they're saying it's going to 600. And it's something that you see on the big bank side, the sell side, where you sort of see these equity analysts constantly playing catch up because they can't take too much risk. They can't be too wrong too many times or call things terribly early. It's safer to move with the herd and the consensus. So we're probably going to continue to see that, right? It's very rare that you see a name like Nvidia that the stock exploded up in price after earnings. Their earnings outlook was overwhelmingly positive. They exhibited insane growth year over year and on the quarter. It's really rare that an equity research analyst on the sell side at the banks would follow that earnings report and be like, nah, Nvidia is going down. I'm repricing from 600 down to 350. Like, that's extremely rare. It'll happen every now and then if there's an insane level of conviction, but if they're wrong, they're kind of at risk of losing their job or losing some clout, etc. And so while everyone's looking at this, I can't help myself because instinctively I'm not a momentum guy. Like, I haven't really made I haven't made my best decisions around, this stock is up 50%. I think it's going to go up another 50% in the near term. Let me buy it on the way up. I'm more of a garbage dump shopper. I like to see when things are a little beat up or bruised or misunderstood, and I like the opportunities there. And so with that in mind, this week I've kind of just been throwing my hands in the air and been like, okay, Nvidia, cool. I'm glad you all are semiconductor experts, but what about Apple being down 9%? What about Nike being down similarly, I think around 10%, and looking at one of its largest losing streaks in a long time? I also, not as, well, yeah, actually I'll throw it in there as kind of bruised and battered because the prices of Rolexes have gone down significantly in the aftermarket, especially. Rolex out there buying, conducting some acquisitions. They bought a watchmaker named Bucherer, a luxury watchmaker with a great deal of provenance and history. And so I'm now kind of shifting my focus to like, hey, some of these great brands, like some of the top global brands in the world, are actually hurting. And it seems like they're actually in a repositioning / kind of let's focus internally so that we can, navigate the medium term a little bit better as opposed to chasing quarter to quarter. And companies, very smart companies, tend to do this when the macroeconomic piece is a little bit uncertain, and they're aware that they can struggle a little bit against some of these larger forces above them. So they look inward and they figure, how can we actually dig deep and innovate and almost cancel out some of these external factors that we don't have that much control over. It's powerful stuff. I really like when I see management teams do that because it's realism, right? It's let's control what we can control. Let's not worry about the things we can't. Apple has done this time and time again. Nike as well. And now that we're heading into the holiday season, post Labor Day, it starts. We've got Halloween, you've got Thanksgiving, Christmas, Hanukkah, all of the end of year holidays. And that's when the majority of consumer goods companies, consumer brands, luxury brands, this is the period where they make, I think it's 90% of their sales for the year. So that's all nice that people were a little bit negative, that earnings weren't as strong for some of these massive brands, but they're definitely working on something, and I think that the holiday season is going to be full of surprises and some disappointments. So I'm really eager to see that. And let's see. Yeah, I'm eager to see next week. We're going to do a portfolio review next Monday. In particular, I don't expect too much action other than, the political stuff that's going on that I do not even want to get into. But we're going to do a portfolio review next week. If you didn't hear me last week, I decided actually to go underweight with one of the positions in the portfolio called Penn Entertainment. It was the online and physical gambling company that had bought Barstool and then sold back Barstool to Dave Portnoy for $1. And I was really bullish on, the symbiosis of those two brands. And now, my strategy is somewhat busted there. My thesis is busted. So decided to reduce the position to underweight. Remember, the portfolio is equal weight. So every piece has an equal weight within it. So now I'm cutting Penn in half to try to reassess the situation and take a pause there. But we're going to have a meeting next week. There may be some additional changes, some things I might add, some things I might remove. So tune in. Monday's going to be all about that. Anyways, guys, take care. Have a great weekend. Jump in the Discord. We've got some new content there, some new educational stuff, some research, some charts. So it's starting to pop off in there. All right, guys, take care.